Welcome, everybody, to another edition of the Asset Backed Podcast. I'm your host, Andre Sandate. I am excited to bring back a former client and also an expert in financials, Derek Pilecki, the founder, CEO, and portfolio manager of Gator Capital Management, based in Tampa, Florida, is my guest today on Asset Backed. Welcome, Derek, to the Asset Backed Podcast.
Thanks, Andre. It's great to see you.
Yeah, it's great to see you. It was good to catch up offline. I'm glad to hear that the kids are going gangbusters like mine. Today is the official start of summer for me here in Atlanta. So hopefully nobody will jump up here with a surprise and interrupt our show. But I'm glad to hear that you and the family are doing well, and I can't wait to hear more about what's going on at Gator. Before we talk about financials, and I know we're going to spend a lot of time today talking about banks and what's going on in the boardrooms at banks with respect to the interest rate environment. Tell us a little bit about your backstory.
Yeah, so I've been running my firm for 16 years. It'll be 16 years next month. And prior to starting my firm, I worked at Fannie Mae, the big mortgage giant. The hated mortgage giant.
Yeah.
Back in the 90s, it was one of the most admired companies. I worked in their mortgage portfolio doing interest rate risk analysis, and so it was a great first job in finance. Their long mortgage-backed securities and CMOs and short agency debt, including a ton of structured notes. And so I got to learn about almost every type of fixed income instrument. And so that was great. And I went back to business school to make the transition to equity research and came out covering financial companies, worked for a couple small value-oriented investment firms, and then was recruited to GSAM and worked for their growth team. So I covered financials for Goldman's growth team for 5 years before launching my fund.
Yeah. And financials for many people who are not in the financial world day in, day out, like you and I, it's like, complicated. Why is it so complicated? So many acronyms. I want to ask you some fundamental basic questions about what attracted you to financials with the complexity and with a lot of, a lot of the things that attract people to the investment industry and asset management, but then within that, financials could be even more complex. You just talked about agency, CMOs, et cetera, working at Fannie Mae and understanding all the fixed income products and strategies. What is it about financials that got you excited? If you go all the way back to your days right out of Duke.
Yeah, I am just attracted to the business models within financials. I think there's a variety of business models. A capital markets firm versus an asset manager, an insurance company, banks, they all have different business models, different income statements. And I just find it fascinating. Growing up, my dad worked for the Federal Reserve. He was a bank examiner for the Philly Fed, and they put him through law school. We moved to DC, and he worked as an attorney for the Board of Governors of the Federal Reserve. And so, the dinner table conversation was always kind of around banking. So it was kind of a natural thing for me to, not be scared away from banks, right? We talked about bank regulation and bank mergers. And I remember when I was in college, we went through the S&L crisis. And by that time, he was in private practice. And just some of the stories of what was going on with banks and what made a good banker, just really attracted me to the industry.
Yeah. So it's sort of like being the coach's son or daughter, right? You just sort of grow up around the game and you sort of are exposed to it. And I can completely think back to that first time we met in Nashville, Tennessee, at an industry event. And, you stood up and talked about your strategy. And at the time I was coming out of working in banking myself at SunTrust and Regions for 4 or 5 years and was starting in the industry. And I thought that's somebody that I need to go meet and talk to. And then lo and behold, we worked together for a few years. And I'm just excited to have you back on the show to talk about this 15 plus year run you've had with your firm, Gator Capital Management. But more selfishly with the Asset Back podcast, I'd love to ask you, about just the health of the overall financial sector. And I know banks is not the only thing that you do at your firm in terms of research, but it certainly has had, bigger parts of the portfolio over time. So let's start there. Let's talk about banks because it is top of the news channel makes the headlines. But there's
Yeah,
two narratives. Yeah, there's two narratives. There's the Main Street narrative of bad office loans and credit risk, and then there's maybe a second narrative that isn't often talked about. What is often missed when people think about banks?
Yeah, I mean, I think banks are still recovering from the regional bank crisis of last year, right? I mean, we just had this huge shock to the system of the three big bank failures in last March, and what we're still dealing with is the interest rate risk that these banks still have. That they made a ton of fixed rate loans and bought a ton of low coupon securities during the 2021, 22 timeframe, and those loans and securities are sticking on the books for a long time. We all talk about people with low coupon mortgages. They're not going to leave their house. They're not going to prepay that mortgage. You have a 3% mortgage. You're not going to leave your house. So the banks are stuck. A lot of banks are stuck holding that paper. And so I really think that when people talk about, bank stock investors are most focused on interest rate risk right now because we're all concerned about credit risk, right? I mean, it's topical, it's obvious. We hear about the office buildings that are vacant and that are going a foreclosure auction for 83% discount to the previous sale. That's all happening, right? So a lot of those buildings are in commercial mortgage-backed securities or owned by foreign or lent against by foreign banks. The credit metrics for the regional banks aren't that bad right now. Like they've improved their disclosure. They show us what their office loans look like, what their multifamily loans look like. It's not a huge problem currently. It could become a problem later this year or next year. I think the central issue right now is interest rate risk. There's a bunch of banks that have too many mortgage-backed securities, too many fixed-rate loans, and with the competitive deposit environment, they're really getting squeezed, and they're just sitting there waiting for these loans and securities to mature, and it's going to take a long time. And so I think that's the real issue when we look at these net interest margins that have compressed. How long will it take to rebound? I think it's going to be a while. So I think that's the thing that investors, generalist investors, aren't really as focused on or compared to the credit risk.
Yeah. So when you talk about a bank investor versus maybe just a general equity investor, if you look at the bank sector, you talked about how there is a really competitive environment for deposits, and that net interest margin is compressed. And so, where are banks that you are looking at and saying there's a constructive set of activities happening at these institutions versus maybe another subset? What are you seeing? What are the things that and I don't want to call them growth banks, but more attractive from the standpoint of their balance sheet, their fundamentals?
Yeah, well, I think there are some bankers who wisely did not load up their balance sheet with mortgage-backed securities during the pandemic. Right? So right during the pandemic, there was huge deposit flows. Quantitative easing just flooded the system with liquidity. The banks saw huge deposit growth, like way above trend deposit growth. And it was a question of what did the bankers do with all that excess liquidity? A lot of them just invested in mortgage-backed securities like Silicon Valley. But other solid banks did too, like Glacier Bancorp in Montana, great franchise. They saw a flood of liquidity and they bought mortgage-backed securities. They're not the only bank like that. There's a lot of banks who just took that excess liquidity and invested it out the yield curve. But there are some bankers who didn't do that. And those bankers who didn't do it are in the catbird seat. There's the spreads have widened on loans. They can continue to grow at these wider spreads at these higher rates, and they can continue growing. And so it's a small subset of these banks that wisely sidestep the low interest rates, and now they're in a very good position to continue lending. What they need is a little bit more loan growth or loan demand. Loan growth demand is really down because obviously real estate investors aren't buying new buildings now or new properties because the numbers don't pencil with high interest rates. But there is some loan demand out there, and these bankers who sidestepped low interest rates are able to take advantage of it.
Yeah, there's a lot of themes that I want to sort of talk about. One selfishly because of the show, the Asset Back show. We are we are constantly trying to sort of understand this narrative around the growing asset-backed finance market, right? It should be everything from student loans, aircraft loans, all the way to mortgages and auto. And I want to talk about that. But before we do that, I want to ask you back to banks for a second. When you look back at the career you've had of looking at banks and getting to know bank management teams and understanding the characteristics and the qualities as a I don't want to say you're a value investor, but certainly trained at Chicago and trained at some of these organizations that you came up in. When you look at banks and you say, okay, finding loan growth, competing for deposits, what are some of the different levers? Because when you look at 5,000 to 6,000 banks, how many do we have in the U.S.? It is such a different just playing field than, say, Europe, right? Where there just aren't as many banks. And I always ask the question to bank investors, do we have too many banks? But what are the levers that these management teams can pull in this type of an environment? And as a growth as an investor that's looking for growth and looking for those sort of proverbial diamonds in the rough, what are the things in those management teams that really stand out?
Yeah, I mean, I would say one thing that really stands out is like not being distracted, right? So the organic growth is the most valuable growth that a bank can have. So, and the way you get organic growth is from your existing teams making more loans, hiring bankers. You steal bankers from the bigger banks, or some of these failed institutions had great client-facing bankers. You hire them, and if you're not distracted, you can make those additions to the team. Where you get distracted is if you have problems in credit or if you do an M&A transaction. So M&A, although it seems pretty attractive, like put two banks together, cut out a bunch of costs, returns go up, it's a huge management distraction for a 2-year time frame. And you can't really grow organically while you're in that integration period. And so you're internally focused, you're not externally focused. So, I think that's why when you see deals, even though the accretion on deals seems very high, the stocks don't react, because I think investors just are like, oh, that management team is going to be distracted for the next 2 years. And it's going to be hard to value the bank. And so I think that distraction, avoiding the companies that are going through M&A that are potentially distracted is one thing to look for.
Yeah, let's I want to ask you about CRE as well. I know that the popular narrative is, yes, post COVID, you have all these empty office buildings, and a lot of these mortgages are either upside down, or you have leases that you've restructured all the leases you can restructure. There's just less demand, etc. What do you see at the banks that you are following when it comes to CRE?
Yeah, I mean, we're seeing some stress on the office portfolios, but what we're seeing generally across the industry, office is about 4% of bank loan portfolios. So not a huge number, but significant. And then generally in a generic bank, of that 4%, about half is somehow related to medical. So doctors' offices are in better use than a typical office building, right? And then you break it down further then there's suburban office and then owner occupied office. And so there's categories you can kind of cleave off to say, okay, those loans are probably fine. Like if a company owns their office building and they have a loan against it, they're less likely to default rather than an investor-owned property. And so we are seeing some issues, especially in Chicago, right? I mean, there's Chicago downtown core is really problematic, and we're seeing across all the gateway cities with long commutes. New York, San Francisco, LA, people just don't want to spend an hour and 15 minutes commuting to an office downtown. To counter that, we're seeing return to work, right? I mean, so companies are starting to mandate people showing up in the office. When they do return to work, say it's 3 days a week, it's Tuesday, Wednesday, Thursday, you have everybody there Tuesday, Wednesday, Thursday, you still need the same amount of office space. It's not like you can do a hoteling arrangement some people show up on Monday and Friday if you have everybody there the same day. Now, certainly some back office operations, you won't mandate to come back to the office. So like, I think the natural demand for office has to be lower going forward. New supply is also close to zero. So we have that offsetting a little bit. But certainly there's going to be problematic issues within the office portfolios. But at this point, I don't think it's going to be, it's certainly not a capital issue. It might be an earnings issue for one or two banks occasionally, but we're coming from such a low level of credit losses in 2021, 22 that we're kind of just normalizing here. So it's what we're not clear on is, will we come back to a normalized credit loss ratio and it'll stop there, or will it keep going to a higher problem level? I would say these things take a long time to play out, and it's not going rapidly. So we're not seeing a sudden surge in credit losses in the bank portfolios as of right now. But that doesn't mean we can't see it as we get in the back half of this year or next year.
Yeah. And the conversation started with interest rate risk, and that being, probably more of a prominent part of your underwriting, and certainly the discussion amongst management teams and boards. I want to ask you about, as a bank investor, again, it's not the only thing that you do at Gator. You look at all different parts of the financials, from insurance and capital markets and asset managers, et cetera, and even fintechs. And I want to talk about some of those other areas. But on the subject of banks, a couple more questions. You made the comment in our pre-show about this is the first cycle with private credit really having a seat at the table. And for the longest time, banks were the only game in town, largely. Now you have private credit, asset-backed. The podcast, we interview a lot of private credit investors, and you hear different things from different investors. Some work a lot with banks, and bank partnerships are a really big part, depending on the size of the private credit firm and franchise. But when you think about banks and private credit in the same conversation, what are some of the initial thoughts that come to mind as you think about where we are in the cycle?
Yeah, I mean, I think that whole aspect of having private credit involved this time is really interesting, especially from even a more macroeconomic view. Like the worst recessions, like say take 90, 91, that recession was terrible because we had a liquidity crisis amongst the banks and there was no alternative. The banks just stopped lending. There was nowhere else to get loans. Kind of same thing in the great financial crisis, right? I mean, it was liquidity crisis, lack of lending makes a very deep recession, as opposed to 01, 02, where the banks were in pretty good shape. They continued lending through that recession, and it was a pretty shallow recession. So like, to the extent that banks are pulling back and not making new office loans or CRE loans, but we have private credit stepping in at a higher price, but still you can still get credit. Will this make any potential recession we face more shallow, right? It's not like you can't get a loan at all. You can get a loan at the right price. And so I see banks working with private credit. I mean, the regulatory environment, the regulators want the banks to take less risk, right? And the bankers would rather provide leverage to private credit than make a direct loan themselves. So to the extent that private credit can make the commercial mortgage and then get some financing from a large regional bank, I mean, I think that makes the banking system safer. The private credit's taking the first loss risk. They're experts at taking credit risk, and they're not beholden to the same regulatory issues that the bankers are. I think that's a pretty elegant way for the banking system, to take on less risk while still funding these projects.
Yeah. So you raised the notion of the regulatory environment, and the regulators want the banks to take less risk, which does, if you will, play into the hand, if you will, of the growing private credit asset class and industry. You've seen some gigantic funds raised, and you seem to be able to pick up almost any paper these days and read about the golden age of private credit, and there's just insatiable demand for yield. With that said, you have a little bit of a regulatory background, right? You mentioned your dad worked at the Federal Reserve, and I would love to get your perspective on the regulatory environment as it relates to banks. And what is this looking like for them over the next, 3, 4, 5 years? Because I've heard from numerous private credit firms that have said you can't walk into a bank and get a loan anymore. Now, I don't know how much of that's conjecture, how much of that's reality. You said, regulators are saying they want banks to take less risk. What does the reality look like on the ground?
Yeah, I mean, I think it's hard to get loans these days. Like, I think it's, I think there's a lot of bankers who are just taking care of their core customers, that they're not looking to expand into new relationships. They're certainly not looking to add on credit without any deposit relationship, which a lot of real estate investors don't have deposits, right? I mean, they're asset rich and cash poor. So, I don't think that bankers are looking to really ramp up their commercial real estate lending at all. And so I think
Yeah.
that's, I think when you think about the banking industry, like 30 years ago, 30, 40 years ago, every bank looked like JP Morgan, right? I mean, a commercial mortgage, commercial bank, a little bit investment bank, trust bank, credit card, mortgage. And now regional banks have been shrunk down to, they do small business lending and they do CRE. And so when you look at some of the metrics of CRE as a percentage of loans or percentage of capital, there's a lot of banks that are over their skis on having too much CRE. And I think the regulators want to bring that down. And, CRE is a risky business. We've had pretty clear sailing for a number of years here. And I think I think that you get back to your original question of what's the regulatory environment like. I think the regulators are under a lot of stress. Like, I think those bank failures last year embarrassed the regulators.
Yeah.
And I think that environment's going to persist. Like, the regulators are, they're defensive, right? Like, bank failures are no good. And the way those bank failures went down, where it was a pretty obvious risk of interest rate risk, it's unacceptable. And so I think the bank regulators are under a lot of stress. And I think in turn, the bankers are under a lot of stress because the regulators are not, they're trying to protect themselves by making sure the banks don't take any unnecessary risk. And so
Yeah, we can't have another SVB or another weekend where a Sunday night rescue has to happen, right?
not at
Because it
all. I
just
mean, it's
keeps
crazy.
spooking the markets. Yeah.
For
Yeah.
sure.
Just when you
I
think
mean,
you're on solid footing.
I would say that, like, I mean, I know this is asset back for podcast, but like, the deposit insurance system is still vulnerable, right? I mean, we still have, there haven't been enough changes to the deposit insurance system since SVB that, like, there could still be a massive run on the banks, because everybody has a app on their phone, and you can zap all your money to your Schwab account if you're worried about your bank. And so you could have a
Right.
run on a bank still. And so, like, I think regulators and legislators really need to take a look at deposit insurance. And I mean, I'm in favor of unlimited deposit insurance, like,
Yeah.
or massively increasing the deposit insurance level. There's
Yeah.
plenty.
250,000 just isn't sufficient for even consumers in some
I
cases.
mean, exactly. Like, there's plenty of 75-year-old or 80-year-old people who have more than $250,000 who can't evaluate their bank. Like, look at SVB. It had $16 billion market cap 48 hours before it failed. Any depositor would look at that and say, oh, they're fine. And so, like, I just think it's unreasonable to have such a low deposit insurance limit.
Yeah, no, it's a great point, and something that hopefully, when the regulators can get back to focusing on regulation, it's something that I think is going to be important, particularly, given that we're in an election year. Let me ask you about, when you think about the overall investment landscape of financials. One thing that I recall about your approach and strategies, you look for the inefficiency, you look for the complexity, you look for the areas that are harder for maybe the generalist analyst who dabbles in banks or dabbles in financials to really uncover. Is it fair to say that complexity and that inefficiency and just the large number of publicly traded banks creates a pretty attractive playing field in which to look for ideas? Is that fair?
I mean, I think that's exactly true. Like, in the small mid cap financial area, there's a lot of unique business models that you need some specialized study to understand. Take student lending, for instance. There's three publicly traded student lenders. You have to invest some time to understand student lending, and the benefit is you only get to cover three companies. And
Hmm.
so, but I've done that, and I don't see a lot of more people, you know, dusting off the playbook to see, like, oh, let me dive into student lending and see if there's an opportunity there. But especially with the given the headlines of free college, or
Sure.
or giving student loans, like, why would you even bother? And but
Right.
there's some pretty interesting companies in this. Those three companies are pretty interesting, and there's pretty uh, inexpensive valuations amongst those three companies. But that's just an example of, like, within financials, there's a lot of nooks and crannies of small to mid cap financials. One of my favorite ones is a couple of years ago. Genworth. We purchased shares in Genworth, and Genworth's a life insurance company. They wrote a lot of long term care policies, and long term care is just a terrible business because you're writing policies for 60-year-olds for when they might go in a nursing home at 85. And so everybody underestimated the costs. And so Genworth has been really struggling with these policies. They also have a mortgage insurance subsidiary. And so they went through a long transition where they were trying to raise rates on their long term care policies and moving the mortgage insurance subsidiary out from under the life insurance company into its own subsidiary under the holding company. They finally made progress, IPO'd 20% of the mortgage insurance subsidiary, and it's publicly traded. It's called Enact. And so when I bought the shares a couple of years ago, if you valued Genworth's life insurance subsidiary and all their long-term care policies at zero, saying that, hey, that's ring fenced, and then the value of their publicly traded mortgage insurance subsidiary, you're buying Genworth at a discount, like 20% discount to the value of its mortgage insurance holdings. And that mortgage insurance companies continue to grow. They had some tax assets that reduced their cash taxes, and that stock had worked. But it's the complexity of, like, okay, this long-term care business is terrible, but there's this mortgage insurance subsidiary. Should this trade at a discount? And when they announced they're going to start buying back stock, that's when I took my position in Genworth. But that's an example of the complexity that's out there within financials. That Genworth's not a highly trafficked name amongst investors.
Yeah. When you think about the additional nooks and crannies, to use your term, of the financial sector, there's some areas I'd love to ask you about. One of those is fintechs, and just how we saw, before 2021, I would say 21, you saw a lot of fintechs getting a lot of VC, and they were going to disrupt banks, and they were going to, claim to be a better version, and a more efficient version of a banks. And you saw a lot of VC give a lot of capital to these tech startups, and then sort of like they woke up and realized, wait, this is a different business, than this is a lending business, not necessarily about just grow at any price. And I don't know that they're going to keep funding these businesses. And I think we've seen a lot of pressure on some of these fintechs, and some of them will probably go away or have gone away. What did that whole maybe you're not investing, you're clearly not investing in IP pre-IPOs and VC, but what did that tell you about the tech community? I'm just curious, when you saw sort of that happening, because I'm sure there are lots of examples over your long career of, we're going to go disrupt banks, and we're going to do this better and cheaper. But what comes to mind when you think about that episode?
Yeah, I mean, I think there was a lot of innovation to come from that episode. Like, there's a lot of outside the box thinking. And so, specifically when I think about Venmo and Cash App, right? I mean, those are pretty interesting businesses, and they were able to take a lot of share, and they were able to get a lot of consumers to participate in those platforms, and it forced the banks to come up with Zelle. And Zelle's been growing; it has very high payments, but Cash App and Venmo are going to stick around for a while, I guess. So I think there's interesting businesses that come out of that, and there's good customer innovation. I think we have all benefited from having money, peer-to-peer money transfer. It's just
Yeah.
easier to live life, to
Yeah.
share expenses with friends, whatever. I think I guess the area where I was most skeptical, you mentioned the personal lending. I guess the area I was most skeptical about disruption was on insurance, so auto insurance. I mean, I think that the big auto insurers like State Farm, Geico, Progressive, Allstate are very, very good companies, and they spend a ton of money on advertising. So to think that like they're lazy companies that you could disrupt, I I thought that was a stretch. So like these personal auto insurers that were going to come and take over the insurance world, I thought was a little bit of a stretch. And
Hmm.
those companies have had a harder time. Personal loan companies. I mean, I I think it's I think they've done a good job and have served filled a need there. But personal lending, it's a low multiple business. Like look at Discover and Capital One. They trade it, best case they trade at 8 times earnings. You know, 1.2 times book or 1.4 times book. Like it's for a fintech to get a high valuation on personal lending. I mean, it's just not a high multiple business. Like and getting this is a little tangential, but like Goldman entered personal lending too, and they've exited it. But it was like,
Right.
why is Goldman getting into consumer lending? They could just buy Discover at 8 times earnings, and you have the greatest investment banking franchise of all time, which is a high multiple business. Why dilute it with personal lending? So I agree with you. Like these fintechs who are trying to use their balance sheet to grow, it just lowers their valuation. What you really want is a fintech that had some asset light business model, which Square and PayPal have done.
Yeah.
Those are asset light
There's
businesses that are payment oriented.
Yeah, yeah, and they scoop up transactions. I want to ask you about some other areas that I think are quite interesting. The first one is property and casualty. It just seems like every time you turn around, there's another major natural disaster. There's a major storm or fire, and it just seems like rates. Not that there's as much home buying. We saw the numbers come out yesterday. I think the April numbers for home buying were down again for the third consecutive month. But a big part of this reset is insurance. In Florida, in particular, you live in the state of Florida. I can only imagine how much premiums are going up in the state of Florida. But overall, property casualty, maybe you have exposure to it today, maybe you don't. But just curious about your take on that sector.
I mean, I think climate change is real, and the insurers are pricing for it, right? And so I think pricing has been going up. I think on property reinsurance, prices didn't go up as much this year as they had in previous years. Certainly on casualty reinsurance, prices are going up, and I think there's a lot of underpriced casualty business from the 2015 to 2020 timeframe that people need to raise prices going forward. The industry generally underpriced casualty business. So I think it's an interesting area. We're not involved in a ton of insurance companies right now. We own one homeowners insurance company that's focused on the state of New York that is kind of benefiting from the big companies exiting Long Island, and so that coastal exposure on Long Island is there's a lack of capacity there, and so that's really the only insurance company that we're involved with at the moment.
The two areas that I know you've been involved in these areas for a long time, and you were one of the first ones, one of the first financial specialists that got real constructive on the publicly traded asset managers, particularly alternative asset managers. So I'd love to spend a little bit of time talking about asset management in general. So you have a deep background as do I in asset management. And then I want to talk for a minute about capital markets. So let's start with asset management. When you think about the universe of asset managers, you have this notion of traditional versus alternative. You also have passive versus active. I'll let you pick where you would like to start, passive versus active, or traditional versus alternative, or maybe both.
Yeah.
But when you think about asset management, these are gigantic forces that are disrupting this industry, changing this industry. And we even saw yesterday, I think KKR announced a partnership with Capital Group, the sponsor of the American funds, long a bastion of portfolios for financial advisors, announcing that they're going to partner up on a couple of offerings, which is just fascinating. So, what comes to mind when you think about asset management?
Yeah, I mean, I think private equity managers are a great business model. For a long time, I've told investors, don't invest in Blackstone or KKR's fund, just buy their GP, just own KKR stock. Um, Now, that being said, we're at an interesting point where there's a lot of big institutional firms that are, or institutional investors who are over their skis on their allocations to private equity. Distributions aren't coming as quickly as they
Right.
expected, especially in VC. And so they don't want to make new allocations because there's a little bit of liquidity crunch there. So, like, are we at a temporary place where fundraising is going to be harder for the big private equity firms? Not really clear to me which way to go there, but I know generally I think those firms are going to continue to grow and have very good business models. The one that I'm really involved with at the moment is Carlyle Group. I really like the new CEO. I think the previous CEO transition had been botched by the firm.
Yep.
I think the new CEO has a huge canvas to work on. Like there's a huge expense cutting opportunity at Carlyle.
This
Carlyle
is
had always
Harvey
run
Schwartz, the new CEO.
exactly.
Yeah.
So
Yeah.
Carlyle had always run their business of, we're going to run the business on the management fee and pay ourselves on the carry. And the when the other publicly traded managers came out, Carlyle and Blackstone and KKR, all of a sudden they were earning 20 or 30% margins on their management fee, and Carlyle was like, wow, we break even on our management fee. So like there was just a heavy spending culture at Carlyle that I think Schwartz is going to, not clamp down on, but just like make intelligent choices about
Yeah.
improving the margins there and reducing some of the spending. And then there's a lot of opportunity on the investment capability side at Carlyle, and great brand name, and great at raising money. They just have some gaps in their investment arsenal that he can fill and grow the firm. So I think, and
Yeah.
the valuation's way cheaper than its peers, even with those opportunities. So I
Yeah,
think
I
that's
mean,
interesting.
when you think about them, you think, private equity, defense, government. I mean, that's a sort of a gold-plated franchise. But when you think about them, you necessarily don't think credit. You don't think secondaries, in some of these other areas. And I think all of them, and I'd love to get your take, seem to really, from a capital flows perspective, really are eyeing not only foreign markets as a source of growth, but also the retail investor as a source of growth. And when I say retail, I mean, trying to go after that high net worth retail investor that's being served by a financial advisor. It seems like all of the more successful ones that are growing, number one, have product, and they have a way to distribute that product to retail, both globally, but also importantly in the US, where that average investor is not woefully, but they're underallocated to alts relative to their family office or institutional peers.
I mean, we've had a bull market for the past 14 years, right? So there's a ton of investors who have historically not invested in alts that have a lot of money now, and you know, they're people with, 5 to $25 million or even more that historically have not invested in alts. So the access that the private equity managers are trying to get to those people are coming through investment advisors or financial advisors.
Yeah. Let's talk about capital markets. When you talk capital markets in the context of Gator Capital Management, what does that universe look like? I'm curious.
Yeah, I mean, it's the investment banks, right? So it's the
Okay.
Goldmans and Morgan Stanleys, the Barclays, UBS, the capital markets really hit the cover off the ball in 2021, with the SPAC craze and the IPO boom. Those businesses really were busy and had a lot to do. And then there was, the pullback in 2022 really, capital markets revenues were really at a cyclical low, and we're just starting to see that's coming back a little bit. Late 23, early 24. 24 has been a good year for capital markets growth. A lot more trading, a lot more business being done. I think when rates were going up so much in 2022, there's a lot on the debt capital market side. Things were pretty quiet. So now I think the stable rates, 10 years staying here around 450 makes a better environment for issuance. And people are like, okay, this is, there's not as much volatility. We have business to do. Let's raise some debt and, lock in some funding. And so I think the capital markets businesses are in a nice recovery mode from the cyclical lows of, 12 to 24 months ago.
I want to ask you about securitization. It up until 2008, a lot of folks didn't know what a CDO was, didn't know, maybe they don't know, but you saw so much innovation in the asset-backed securitization markets. And then it was, I would say largely, the veil was lifted with the GFC, and we saw a lot of banks suffer. And there was just, it exposed just how interconnected the global capital markets really were. I had a guest on last week who talked about there's somewhat been a loss of innovation in the securitization markets because you saw this talent leave, and you saw some of these securitization markets sort of seize up. And you have private ABS, you have public ABS, but obviously the banks you just mentioned are big players in the securitization markets. Can you talk at all about securitization as it relates to some of the bigger areas like auto, student loans, mortgages, et cetera? I mean, are origination volumes just generally down? And that's why we don't hear as much about securitization. Why has there been, for example, such a more and more chatter and talk about private ABS? I'm curious, do you traffic in these universes, or does it touch the capital markets names that you follow?
Yeah, I mean, it's very, my exposure to that's pretty small. So
Okay.
I think there has not been a lot of innovation because there's been some regulatory changes and about what risk retention is. And so I think that there's not been, people haven't been paid to take more and more risk or come up with more innovative structures. And so there's just been lack of innovation there. And it's been more, it's boring because it's like the structures are tried and true, and there's not much innovation there. And so it's just basic business.
And that would explain why some of it's maybe moved to the private markets. Let's talk about, we touched on this earlier, but I want to ask you, when you talk about non-bank lending and that universe, you talked about Stripe and Venmo and Cash App, and I look at those as more transactional, like processing and the technology. When you talk about non-bank lending, a source, 10, 15 years ago, it was Prosper, and it was all these peer-to-peer type of lendings. I'm not thinking that's what you're talking about when you say non-bank lending. So I'd be curious, how big is this market? Who are the players, and who seems to be doing a decent job at it?
Yeah, so I mean, non-bank lenders on the consumer side are, One Main Financial. It's a subprime lender. It's the old Citi Financial, AIG, American General business. Or I mentioned Sallie Mae, the student lender. I think it's lenders like that, like Lending Club, Upstart, are currently non-bank lenders, SoFi. And so those are the companies that are non-bank lenders. On the commercial side, there's some commercial mortgage REITs. There's some commercial finance companies that are non-bank lenders.
See, it wasn't my kids today. It was my dog.
I was hoping to get to see one of your kids today. I'm bummed they haven't shown up yet.
You might see one jump in. I mean, that's the nature of it. So there's a number of non-bank lenders across mortgages, across student loans, and these other areas.
I like non-bank lenders. They tend to be monolines. They tend to have higher returns on equity than banks. They tend to grow a little bit faster, but they don't have as much stability, right? Because they don't have the deposit franchise. So they, a lot of times they're funded in the capital markets, and they can run into problems with the balance sheet if they're not more stable on their funding side. But they're interesting businesses and they're innovative, and they can grow faster than a typical bank. And so I think they're interesting businesses from time to time.
But like you said earlier in our conversation, the complexity, the inefficiency, they can run into problems just because they don't have the deposit base. All the more reason why, only specialists probably are really starting, to really be constructive on doing the underwriting, doing the work and the research.
That's right. I mean, I
Yeah.
think it's a specialized area that trafficked in by a lot of financial sector specialists, not necessarily generalist investors.
Yeah. How much, when you look back at the time that you have been running Gator Capital Management, and you're doing that away from, call it Wall Street in New York, you're doing that in Florida. And I know you used to get this question from investors, and I'd love to get your take on it now, years removed. How much does being outside of kind of the trading of ideas amongst other funds, other PMs, like how much has that benefited you? I'm curious, where you can really, sort of burrow in and concentrate and not be caught up in the noise and the hype. How much has that impacted your business and your
Yeah, I mean,
approach?
I think is an interesting question. Like, I definitely talk to other investors some, but not to my network amongst my peers is not extensive. Like, um, I'm not in touch with other investors on a daily basis. So, I see them at conferences a couple times a year, and we're cordial. But I just kind of march to my own beat and do my own research. There's a uh, few people that I talk to that to share ideas, but really it's a lot of my own research and just doing my own independent thinking away from what's fashionable amongst amongst the financials crowd. So
Yeah, I
I
mean,
think that's a
yeah.
huge benefit.
Yeah, it sounds like it is a benefit. And, without talking about your book and the strategy, you've always operated at the beat of your own drum, right? You tend to not hold the names that the sector or the indexes hold. You tend to do a lot of your own idea generation and research, independent, and successfully, relative to your index and your peers. I want to ask you, um, kind of a couple of final questions as you think about financials. We are in an election year. It seems like you can pick up any newspaper, turn on any news channel these days, and get an opinion one way or the other, depending on what you're looking to hear. But financials, and you talked about this at the beginning of the conversation. A lot of the things that get talked about in the media that make headlines aren't necessarily the things that you're paying attention to. And one of those things you talked about was interest rate risk. So I'd love to ask you, in an election year, with the Fed attempting that soft landing, what's your what's your outlook for the sector?
Yeah.
How do you sort of assess how Powell and the Federal Reserve have done, given a quite tricky hand to play? And clearly, this is going to have a big impact on the names that you follow.
Yeah. So I guess one thing that I'm trying to reconcile is my portfolio. When I look at my portfolio now, not by design, but just when I try to be objective and say, would my portfolio benefit from a Biden victory or a Trump victory? I think it would benefit from a Trump victory. The
Hmm.
problem is, I think Biden's going to win, and I know that's not a consensus view. Like, I think, especially amongst financial people, yeah, everybody clearly thinks Trump's going to win. But, I guess my reasons for why I think Biden's going to win is I think the polls are wrong. I think, people with landlines who get called for polls tend to skew older and Republican. So I think it overstates Trump's support. I think, number two, I think there's going to be a turnout issue for Trump. We saw it in that primary in Indiana where Nikki Haley dropped out of the race months ago, and she still got 20% of the Republican vote. Like, I just think Republicans, there's enough um, Rhino Republicans that they just won't show up to vote for Trump. They just won't vote at all. And then, I think there's some social issues, namely abortion, that are going to really swing towards Biden's favor. So, like, when I look at the election objectively, I think Biden's going to win. My portfolio is set up for a Trump win, not because I said Trump's going to win and I'm going to buy there. Just naturally, banks will do much better under a Trump regulatory view, and so I don't have that reconciled. Like, how am I going to approach the election here with who's going to win? I'm kind of waiting to see. We have to get more into the meat of the race before.
Yeah.
I guess the one thing I would say about the election year, like usually election year, the market doesn't do much until the election happens, right? And so,
That's
like,
right.
we've actually had a pretty strong market for an election year so far. Like, S&P is up 10%. We're sitting here at close to all-time highs. That's a little bit surprising. So, like, is the market, and how do I interpret that? Is the market looking through the election? Does the market already know who's going to win and it's comfortable, or is it just a Fed phenomena where we're expecting interest rate cuts and the economy is stronger than everybody expected, and so the market can power through an election year? Because so it's not clear, and just trying to sift through that. And you ask me tomorrow, I'll have a different answer for you, right? But
Yeah.
it's just,
Yeah.
like, I'm
Well,
still trying to figure it out. Like, it's an open
yeah.
question in my mind. Like, why has the market been so strong in the face of an election year?
Yeah, that makes a lot of sense. I mean, you have to keep your head on a swivel. Last question, when you think about the Federal Reserve and you think about Jerome Powell, chairman of the Federal Reserve, and trying to determine, are we going to see a rate cut this year? Are we going to not see a rate cut at all? Are we going to see a rate cut, a rate rise? What is your overall grade that you'd give the Fed? I'm just curious, because I would imagine you're paying attention to this as much, if not more so, than most of the people that I talk to. Certainly, the people that I have on our show are paying a lot of attention to what's going on in the macro economy, what's going on in their portfolios. So I'm just curious what kind of grade and assessment you would give him, because it's an incredibly difficult job.
Yeah, it's a very hard job. Like, it's, I mean, and I'm also looking at it with hindsight here, right? I mean,
Yeah.
there's some things like, did Q quantitative easing have to continue? Did they have to continue to buy all those mortgage-backed securities and treasuries
Yeah.
into 2021 when the market was red hot and that we had this SPAC craze? Like, I don't. There's some things that, in hindsight, I bet they wish they could have a redo on, right? And so it's a very hard job. I guess I didn't agree with the last couple rate increases. Like, I felt like going to 4.5% on the Fed funds was enough. Like, I didn't think that they needed to do the last three rate increases. So, like, could they cut three times and go back to where I thought they should be in the first place? Yeah, I think this inverted yield curve is really hard for the banks. I think it's, you know, but I think the Fed also wants the 10-year higher. I mean, I think that the Fed would like. I guess the other thing about where interest rates are is, I kind of agree with some of the people who are saying the higher rates are causing inflation, because if you think about housing supply, we're short housing. We need more
Yeah.
housing. Higher rates does not promote more housing, right?
That's right.
So, like, rents are going to go up because there's not enough housing. And so what are we doing here? Like, and every time I see a solution from the administration, it's, let's create more housing demand. Let's lower the cost of mortgages. Well, that doesn't create more supply. We need to address housing supply. That's the issue. And more housing supply will lower prices, lower rents, and lower inflation. So, like, we have to figure out housing supply. And I don't know that higher rates is fixing housing supply.
Yeah.
So
Interesting. This has been a really great, tour through the financial markets. We've talked about so many sectors within financials, including banks, insurance, asset management, capital markets. I want to give you the last word, though. We've known each other for, a number of years. You've been running Gator now for 16 years. Congratulations. When you think about, where the next 15 or 20 years with Gator go, and where you want to take your platform and financials. You've built your team up, and you're in Florida and you're doing this. What are the things that come to mind? Like, as far as, these are the challenges I want to tackle. These are the areas that are most exciting. These are the things as a CEO, as a portfolio manager, that get me excited to get up and focus on this really highly complex area every day.
Yeah, I mean, I'm just excited about compounding my investors' capital over the next 16 years. Like, I've been doing it for 16 years. In 16 years, I'll be 70. I think that's a nice career, and I'm excited. The firm's at a decent size now. We compound investors' capital for another 16 years. We'll be bigger than I ever thought we would be. And so, like, that's just the focus of, like, continuing to put up good investment performance, find the opportunities in these small and mid cap financials where we can put up excess returns for our investors. And I think I think it's a very dynamic industry, and I think there'll continue to be opportunities for our investors there.
That's great. Well, Derek Pilecki, portfolio manager of Gator Capital Management, headquartered in Tampa, Florida. Thank you for joining me today on the Asset Back podcast. Tell us how people can learn more about you. Where can they get in touch with you and hear more of your views on financials?
Yeah, so our website's gatorcapital.com, and you can send me an email. My email address and phone number are listed on the website. And you can also follow me on Twitter under the handle Gator Capital.
Fantastic.
Thanks a lot for having me, Andres.
Yeah, Derek, it was a pleasure. And I look forward to having you back on to get an update on what's happening in financials. Thanks for joining me today on the Asset Back podcast.